Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and it is Friday, March 7th. Currently timestamp 10:17 a.m. So the market's been open for, a little over 45 minutes at this point today. I am joined, as I often am, by Brad Haines, Chief Investment Officer of Juncture Wealth Strategies today. And we're having a very volatile, the word of the day is volatile and volatility. Very volatile time this week. What's going on, Brad?
Yeah, for sure. This has been a wild week for the financial markets, and a lot of equity investors, I'm sure, are somewhat confused as to what's going on because we've seen really big swings of a couple of percentage points with the trend being down. We're down at this stage, as of right now, we're down about 6% off our high, which happens to be our all-time high, which was set on February 19th. So we're off about a little over 6% since that high. Unfortunately, I think a lot of investors feel like we're down 20%. We're getting a lot of reactions from investors and from investors who are expressing a lot of consternation about what's going on in the financial markets. And a lot of that ties back to the news flow, right? The news flow, tariffs, cutting jobs from the federal government, all of that, the communication strategy from the White House has been very, very chaotic and not well thought out. And so, that's just the way. I mean, it was that way in the first Trump administration, and it's turning out to be very, very similar in the second, where policies are made not on a whim, but the way he communicates them is very whimsical in nature. It's very
off
chaotic.
the cuff.
Yeah, it's off the cuff. It's in the moment when he decides to say something, then that becomes the policy. And because he's not a very organized speaker, he doesn't necessarily stay consistent with each statement that he's made prior to that. So investors, households, businesses have pulled back their spending plans because they don't know what to expect. And that uncertainty is more dangerous to the economy than tariffs or any tax increases or have you. I mean, it's disastrous. Increasing uncertainty is not great for financial markets and the real economy, because when businesses and households pull back spending, that affects companies, which affects jobs, which affects household spending again. So it's, I think that's part of the unsettled feeling that investors currently have.
Yeah. So I wanted to clarify a couple of things. When you mentioned, we're off around 6%. I want to clarify that's the S&P 500.
Correct.
Right now. So that headline index is off about 6%. The NASDAQ, what's that one down now? That one's officially hit correction territory, right?
Yeah, that's been the index. That and the small caps have been the two areas of the markets that have hit quite a bit. So 540, 488. So they're off about a little less than 10% right now. Hold on.
They bounce back up slightly.
Yeah, well, it actually just pulled back to negative. Well, it's about zero right now. So we're officially knocking around that correction territory on the NASDAQ. On the small cap,
and while Brad's looking at that, again, just as a reminder, the S&P 500 is an aggregate of the 500 largest companies by market cap in the United States. So that's our 500 biggest companies. That's a pretty broad index. When we talk about the Dow Jones Industrial Average, that's 30. That's just the top 30. Much, much smaller sample size than the S&P 500. And then the NASDAQ is the tech heavy.
Yeah.
Mostly tech companies are in the
And
NASDAQ.
mostly tech, mostly the very, very large mega cap, you know, dominate that index. So it tells you how they're doing. And
And then
this,
the small caps are anything, what's the market cap for to be officially small cap or below?
I mean, it changes with every index provider, but generally it's under 5 billion in
Okay.
market cap. So 0 to 5 billion. Some people break it up to say, okay, well, there's a mid cap in there and that goes up to 9.9 billion, but it just depends on the index provider. But generally speaking, it's the smaller companies. And the Russell 2000, which is the 2000 smallest companies on the publicly traded by market cap, equity market cap, they're down about 15%.
Mm.
So they're in correction territory, which is great for buyers, not necessarily great for holders as of right now. So
So the other thing I wanted to kind of tease out from that initial conversation is the uncertainty. So, we had the tariff scare back in January, right? Like when Trump came into office and was like, tariffs immediately. That roiled the markets up really good back then. And then he backed off and said, nope, we're not going to do that. And then the markets, lifted back up when he said, no, we're not going to do tariffs right now. This happened again this week, right? So tariffs went back on Canada, Mexico, and an increase on China, right? On Tuesday of this week. And Monday and Tuesday, the markets were like almost in free fall.
yeah, not great.
It was trading halted. I thought I heard trading was halted on Monday at one
No.
point. No? Okay. Um, Never mind. Scratch that from the record. But it was down a lot Monday and Tuesday.
Yeah.
And on Tuesday evening, right, one of the spokespeople in the administration came out and said Trump's thinking about rolling these back. And so futures were up a little bit. We had a little bit of a rally back um, through midweek, but it actually did not hold, right? Like
Correct.
that rally didn't hold. We fell back down. Why? So why is it not quote unquote working again when he backed off and said, "Oh, hold on, we're not going to put tariffs on automakers just yet." It's because from my perspective, and you said this, like from the individual to the small business to the large business to the CEO to the average investor to the institutional investor, no one knows what's freaking going on right now. Right. And so there is such mass uncertainty about, okay, so wait, am I paying 25% more or not? This is not just affecting like, okay, I have to plan for 6 months down the road. This is like, what am I doing next week in a lot of industries? And so it's really affecting current moment decision making for business owners and companies, which is really, really difficult when like most businesses don't have 25% margin to give up, right? They have to make decisions about pricing.
Exactly. And that's the problem is when you don't know the costs, you're not going to spend until you do.
Right.
It's a very basic premise of consumer and business behavior is if you know the cost of something, you can assess whether the benefit it's worth the benefit. That cost is worth the benefit. Well, if you don't know the cost because of really chaotic policy implementation, um, then it's very, very difficult to do any business planning or any household planning. So it's one of those things is when uncertainty like that goes up, people pull back. And so and that increase in uncertainty is probably more of a danger to the economy than the actual tariffs are. Um, I mean, the tariffs are going to bump prices up, the price level up on goods, um, quite a bit. Okay. And part of that is going to be passed on to consumers. Part of it is going to lower equity margins, right? So lowering the margins, someone's paying for it. So the company will probably cover part of it. The consumer will probably cover part of it. Okay. Either way, the price level increases a little bit and the profit margins of companies go down. Now, many people think, well, that's okay. Let the companies pay for it. Well, when companies' profits go down, they have to make decisions about labor force. Okay. Do they need as many labor, because they're going to try to protect those margins. And labor is oftentimes one of the bigger costs of doing business. Um, and then also they're going to make a decision on um, how much profits accrue to shareholders. So in other words, if they lower their profits, okay, because they're paying more in costs, and they don't lay off or rationalize other costs in their business structure, what happens is profits go down. Well, equity prices follow profits. So if profits go down, your stock prices go down. And all the 401ks, right? If it happens across enough places, your 401k is going to have a different number on it because those equity prices are no longer worth those higher prices because now they're generating less in profit. Now, people keep forgetting that 40%, so the S&P 500, 40% of the revenue that they earn globally is from international markets.
Wow. That's a
So
that's a
yeah,
lot.
digest that. So if all of a sudden 40% of that revenue, okay, is now less profitable, okay, then your profits are going to shrink. Now, the Trump administration's hope is that uh, that balance changes a little bit and we generate more economic growth within the United States, right? Um, they've made many comments about the U.S. farmer will just sell more grain to U.S. consumers as opposed to selling it overseas. And that is true, but there's a timing difference there. It takes a while for that to happen. And with the economy, in uncertainty, economic growth is going to slow precipitously. Now, whether we hit a recession, I don't know. I don't think so, but it is going to slow, particularly as, spending plans are delayed. So what's going to happen? Well, stock prices could be in a trading range for the rest of this year until policies are actually in place and we don't play this dumb little negotiation tactic of announcing it, delaying it, announcing it, delaying it, applying some of them, not applying others. So it may be a negotiation tactic for the Trump administration, but it is not great for the U.S. real economy and financial markets.
So when we're looking at this, the thing that we really wanted to talk about today is volatility.
Yes.
And that's what, like, we are experiencing it right now. And you said it at the beginning too, like we have clients that, if even though the S&P is down, again, that's the broader large cap index is down around 6%, but it feels like it's much worse.
Yeah.
It feels much worse. Um, and that that feeling, that imprint of, okay, things are so up and down, it feels bad. I feel like I'm on this whipsaw. I want off this ride. That feeling of I want off the ride is starting to get more and more prominent, is what I'll say. Right. So we're having clients who are like, get me off the ride, get me off the ride.
I don't
even
like it so much.
though
I don't like it so much.
no, but yeah, and that's the thing. Nobody, I'm not going to say nobody. I'm sure there are people who are seeing this and like, yeah, I'm making the most money ever because I'm trading every little blip. Um, but for most people and most investors, especially most household investors, 401k owners, IRA owners, right? People who have their normal amount of retirement money in the stock market right now, that feels really, really bad. And so I just want to be like I understand. I get it, how bad it feels. And we are still going to sit here, you and me, Brad, and say that this is not the time to abandon ship. Like the
Right.
volatility feels bad, but this is the moment where having that grounding of like, okay, what's the historical context? What's happened before? Like we understand it's different, but it still rhymes. So that's what we're going to talk about, some volatility stuff.
Yeah, so I want to make a statement, and I think this is true. Is volatility is the short-term price investors pay to invest in long-term wealth creation. Okay. Um, and volatility for institutional investors who have to meet quarterly results or have to um, give quarterly results to their shareholders or to their stakeholders. Short-term volatility is terrible for them because they have to manage it. Individual investors or households are in perfect situations because they don't have those constraints upon them to take advantage of short-term volatility for long-term gain. It's exactly what Warren Buffett did. All right. Um, Outside of his quote unquote value based type investment strategy, one probably the most important decision he makes is when things are chaotic, things are feeling bad, is when he invests. Okay. And he does that quite well. So, one of the things that I think individual investors, households, because they have long-term time horizons, um, they should sit back and anytime you have a decent price correction, they should figure out how to take advantage of that, not to just suffer through it. And I think that's where a lot of the historical investment industry has done a terrible job is they just had people suffer through it.
Mm-hmm.
And volatility's been almost every single year we have volatility. So
Yeah.
people have to understand that if you're going to invest in stock, they have to sit back and take a longer term time horizon because you're buying a company and that company has a whole structure of a whole organization of people doing things to make you money. And sometimes it takes a little bit longer for those results to show. Sometimes it's very short term. It just depends on the companies you buy. So one of the things from a headline S&P 500 standpoint, I'm going to share a screen so we can look at some charts that we went over 2 days ago.
Mm-hmm. These are fantastic. So if you're listening, we'll talk through them so that you can hopefully visualize. Hopefully you're a person that can visualize things in your mind's eye. If you really can't do that, go over to YouTube, go to Expansive CEO on YouTube, and you will see this episode. And you'll be able to, see the charts with your eyes.
Okay, so this is a chart. Let me make it a little bigger.
I was gonna say, yeah, more and more. There we go. That's better.
Okay, let me. All right. This is a chart of every year since 1980 to through 2000, actually through February of 2025. So it gives you 45 years of data. All right, that's important. It also provides, so that's the gray bar. The gray bar, which is showing you the annualized return or the annual returns for each of those calendar years. So what it also does is it provides the largest, what we call drawdown. Now, for definition, a drawdown is how much it lost value during the year. So if it goes up 10% initially and then winds up down 25%, that drawdown is 35%.
Mm,
So we have to make sure that we understand what that concept is. The drawdown is from the peak to the trough of any intra within the year. Okay.
okay.
Um, and if you, for those viewers, you can see the red dots are the drawdowns. And you can see a lot of them are pretty large, right? I mean, you get some that are small, down 2, 5, 7, 10, 12. Those are the small numbers. Um, the bigger numbers, 49% in 2008. Okay.
Mm-hmm.
I think most, if you were investing during that time, you definitely remember how that felt.
Yep.
But you 34%, 25%, 20%, 28%. There's a lot of data here that shows that in any one year, you can wind up with a very large pullback, but yet still wind up with a really good annual return for that year.
Yeah.
I'm going to give you an example. On 2023, the index returned 24%. The S&P 500 returned 24% for that year, but it was down 10% during that year.
Mm-hmm.
Okay. And that's one of your least volatile
Yeah.
years. For example, we have a year where the S&P 500 returned 16%, which is a fantastic year, but it also had a pullback of 34% within that year. That was 2020.
Yep.
But we have to remember there's always reasons, various reasons why the equity markets pull back. It could be war or geopolitical related. It could be commodity prices. It could be a pandemic. It could be, a credit market issue. It could be earnings issues. It could be the U.S. political um, upheaval. Okay. There's lots of various reasons why this volatility comes about. But most importantly is what has happened to earnings over time. As long as corporate earnings in the US grow, equity prices will grow.
Mm-hmm.
Now, it may take some time, but generally speaking, but people have to understand that you've got to be buying into going through some of this volatility if you're going to have equities, which everybody, I believe, from my standpoint, needs to have a certain percentage of their allocation being in equities just to keep pace with inflation.
Right.
Now, what's weird is prior to 2021, very few people really kind of believe that because inflation had been so low for so long. And then the post-pandemic relief efforts came through. And what happened? All of a sudden, we had 9-10% inflation. And that eats into your fixed income returns really quickly.
Yeah.
And so it's really important that people have some amount of growth assets to keep pace with inflation over time.
So the other thing, looking at this chart that I want to mention and explain in words also, every single year, so it's again 45 years and then 2025 year to date. So it's going to shift from what we see. But 45 years, there were 10 years on this chart with negative returns.
Yes.
10 out of 45, right? 1, 2, 3, 4, 5, 6,
With
7,
11.
8, 9,
Yeah, it's 11.
10. You see 11. I see a zero.
Yep. That's
Are you counting that?
yeah, that's why I'm saying it's 30. It's 11 years
11 years
of
without
zero or
positive
below.
return. Yeah,
Mhm.
okay. There we go. So that's about 24%
Mhm.
of the time over 45 years. That means more than 75% of the time we're having positive returns on this main headline index, even though every single year has a drawdown, right? Like some years, right? Like what was that? 15, 16, 17? Was that 2017? The biggest drawdown was 3%, and we ended up with 19% returns. That is such an anomaly. There's another
That's rare.
1995.
Yeah.
1995 was similar.
Yeah.
Crazy
Yeah.
returns and a 3% drawdown, right? But that is one of the most rare things on this entire chart where we have very little volatility and sky high returns. That does not happen very
It,
often at all.
yeah. Yeah. It's very rare. I mean, to your point, so 34 out of these 45 years, you ended up with positive returns, many of those very healthy positive returns. I mean, for viewers or for listeners, there's a lot, there are a few that are in the 3, 4, 5% range, but most are above 10. And so those are the years obviously you make your money. And so you need to be involved in those during those years. Um, but also, you have to understand the average pullback during any of these years is 14%.
Hmm.
Okay. So that's not unusual. That is very usual. That is what we do. That is how the markets work. I think we've been um, a little spoiled because we've had very low interest rates for a very, very long time, and we have had less volatility than typical. Now, really, since 2020, that's picked back up to normal levels. But we had this period where a lot of people got involved in equity investing, and we didn't have a lot of downturns. And so I think they thought downturns weren't something that we do anymore. Well, guess what? They do. And
Hmm.
uh, and so, people have to be they just have to get used to it a little bit. To get some of these large returns, which then help grow your purchasing power, right? Growing your wealth, growing your ability to buy goods and services, which is what, as financial planners and financial managers, we do, is help our clients grow their asset base so that asset base can produce income, so that income can support their lifestyle for the
Right.
remainder of their life and often into the next generation of their beneficiaries. Um, so that's something that's really important for people to understand. Now, the second one is this chart gives you um, on the S&P 500, how many times a year do we get certain amounts of declines? For example, a 3% dip. How often does the S&P 500 pull back 3%?
According to
Well,
this chart, it says
according to this chart,
7.2 times.
yes, 7.2 times. Now, the data they're taking from is 1928 through 2024. So it's pretty broad. It's pretty long time frame. So almost 7.2 times a year we pull back 3%. So should we panic about a 3% pullback? Probably
No,
not.
no.
Why not? That's just kind of big deal, right?
Right. Well, that's more than every other month, right? If we
Yep.
like that's like almost every 7 weeks ish, if you
Yeah.
put it that way. Like that's
Well, and oftentimes it takes a day or two. That's it. That's it. Takes a day or two, you're down 3%. 1.5% a day, or 2% and 1%, you're down 3%. It does not, it happens fast, and it's not unusual. Okay. 5% mild correction. So going from peak to trough 5% happens almost 3.5 times a year. Okay. Again, do we panic about 5%? No, no, we shouldn't. We shouldn't. It feels bad because if you have $1 million invested and now you're down $50,000, oftentimes people start to do the math of how much time is it going to take me to save that $50,000,
right.
right? And that is incorrect thinking,
Hmm.
because assets go up, assets go down, assets go up, right? And so what I tell people is you don't have to save that amount of money. As long as you own that amount of units of whatever investment it is, as the price comes back, your overall value heals itself. All
Right.
right. So people have to understand that just because it went down, it also means it can go up. Right. And
Right.
so you don't have to replace it with savings. Um, 10% corrections, 10% in my experience over 30 some odd years of managing money is the place where most people start getting nervous. For example, if you have $100,000 and now you're looking at 90 on your statements, that starts to get you a little nervous. If you have $1 million, now you're down to 900. Again, that incorrect math of, oh my gosh, how long is it going to take me to save $100,000? Okay. For most people, it's a long time, right? But again, it's incorrect math. As long as you don't sell out, you're still in the game, you're good. Um, but that is where people start to get nervous.
And
15
it happens how often? You didn't say that.
Oh, sorry. It happens a little over one time a year, every
Yeah.
year on average.
That's that's the thing that people are like, it's like every time it happens, right? There's that panic of exactly what you're saying, like, how am I going to make this money back? But the average is this happens every single year on average, a little bit more than that, actually.
Yep.
And we can, again, looking back at historical returns, the S&P 500 still has long-term averages between, 8 to 12%, depending on the time band you're looking at.
Yeah. I mean, it's an interesting dynamic. And the problem is during the time that we go through a 10% correction, people are listening to the news.
Yeah.
And while I think it's important for the news to put out clarity and tell us what's going on, in investing, that's the worst thing you can do is look at the news because during down when the equity market's off 10% and you're getting nervous, you're listening to the news more than you otherwise would, and the news isn't good. It's usually terrible. There's something going on in the world or the economy or the financial markets. Something is not going well, and the news amplifies that. It overemphasizes that negative nature because that's what pulls viewers in. So for investing, people and clients and investors should put that aside for a while and say, okay, is the issue they're discussing on the news short-term in nature or long-term in nature? Start thinking about what the impact of that event is. Is it short-term or long-term? And oftentimes it's going to seem like it's the world is crashing. It's something's so dramatically wrong. Just understand that the financial markets have gone through many wars, many natural disasters, many pandemics, many flus, many all these things have happened already in our history, and we've still averaged 8 to 12% on the S&P 500, again, depending on the time frame you're looking at. Um, and it's created a massive amount of wealth for a lot of investors. But again, a little over once a year. So usually a 10% correction, what I tell people, it's like if you like Cheerios and they go on sale 10%, what happens? You buy more, right? You don't buy less. You don't sell your Cheerios. You buy more.
Hmm.
They're on sale. You buy more. Okay. And that's exactly what the impetus or the emotional response should be. But unfortunately, it's the opposite for a lot of clients. Um, Going down 15%. So a severe correction happens half on average every 2 years, once every 2 years. Okay. You're going to have 15% down. Okay. Not going to feel great, right? $1 million account, you're going to be down $150,000.
Yep.
Not going to feel great, but pretty regular, pretty consistent, pretty regular.
Hmm. Yeah, over the life, let's talk in lifespan, right? So if you say you got a job, your first like really good job at 30, and you're putting into your 401k and you're saving and you're a business owner and you're like putting money away, right? And over your lifetime, over your working time span, let's say you work till you're 70, just put it out there, right? Like so we give it a 40-year time span. That means 20 times in that accumulation phase, we're gonna experience a 15% pullback 20 times over that time. So if you um freak out and sell in that first 15% correction rather than buy, you just truncated your returns for the rest of your life. And if you
Correct.
do that over and over again, this is where um when we say in this industry, when we say that like the individual investor, right? When everyone else is selling, that's when you buy. That the individual investor tends to go the wrong direction. Um, that happens because of this reason, right? So everyone's getting scared at that 15% mark. Maybe you held tight through the 5, you held tight through the 10. Now it's at 15% and you're like, I can't do it. I got to sell out. What you just did by doing that sellout at 15% is, again, truncate your ability to have a higher return over your entire lifetime when you miss the inevitably. The timing is never ever right with this. You're not going to buy back in at the bottom so that you experience the upswing. That almost never happens. So you're
Well,
going to miss the upswing.
let's dive in on that a little bit.
Yeah.
Over my 30 some odd year career of managing money, I have known clients to sell out at the right time. Okay. A lot of them. And I didn't say a lot, a number of them. They sold correct. They sold at the prior peak. Amazing. Great job. I have not known one of them to get back in when the market was lower than the prior peak.
Ugh.
Okay. So
Yeah.
generally, we walk people through this. They sell at the prior peak. They have cash now, right?
Let's call it 1,000 just so it's easy.
Okay. So a
Like the peak was
thousand.
1,000.
Yep. And I'm going to give you a specific example of one I know. Sold at in 2007 at the high. Okay. Kept it in cash. Good job. Good job. We were down, 50% at one point. Okay. Did he get back on? No. Did I tell him to get back in? Yes. Did he get back in? No. So, and he watched the equity market climb from that low in March 2009 all the way to the prior peak. And he still hadn't got back in. Why? Because he's like, well, I can't buy now. It's already too high.
Yep.
Right? Because he wanted every little problem in the real economy and the financial markets to be solved prior to putting his money back to work. It never works that way. Investing does not work that way. It's a probability based exercise where you have to say, is the probability that 5 to 10 years from now, the equity markets are going to be higher than they are today when I'm investing? And if the probability is more than 50 to 60%, you should be investing in equities. But if you try to say, is it going to be higher 6 to 12 months from now? I mean, anything can happen. It's kind of a 50-50 chance in most years. So that keeps people from their short-term considerations and emotions keep them from reinvesting until almost the prior high or higher.
Yeah, that's what I was going to say. If we use that like 1,000 benchmark example, if you sell out when the index is at 1,000, you watch it drop down and drop down. You're like, see, I was right. I was right. It's at 600. It's at 500. Oh my gosh. Like those poor people who lost everything. And then that's when there's quote unquote blood in the streets, right? Everyone's selling out, everyone's bailing. If you don't buy in, then you don't make your money back, right? So then they're like, no, it's too scary. What if it goes to zero? What if it goes
Right.
to zero? What that's like those are the words. What if it goes to zero? Okay,
And
well,
the media at the same time is reinforcing those thoughts.
of what it, yeah, what if it goes to zero? Like things are so crazy. And so then they watch it turn. It's like 550 and then 600 and then it goes back down to 575 and then it goes back up to 750 and then back down to 650. Oh, see, it's not good. It's not good yet. And then it goes back up to 800 and then 900 and then 1,000 and they're like, "Oh, no, 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 no. What's going on?" And then it goes back down to 850. Like, "See, I told you." And then it skyrockets, right? And then that's when we have usually something's like everything's fine again. Now it's at 1,200,
Now I'm buying back in
right? And like,
because I
oh,
want to miss it.
everything is good now. We're at 1,200. Well, if you literally had left your money, you would have more than riding that whole wave than you do when you take it out and you refuse to get back in. And so, and I think that's where the it's like this push pull between the fear that the market is going to go to zero. And then as the market's coming back up with like a little bit of rockiness, the fear that it's not a true comeback, right? So it's like they didn't get back in at 500, but they also won't get back in at 850 because they saw the choppiness between 500 and 850. And so it's like anywhere along the way, if you get in at 600, 750, 850, you're better off. But there's like this the hesitance, the fear really getting in the way of, again, it's like that little voice of what if it goes to zero? What if this is the time? What if
Yeah.
this is it? This is like when the economy implodes.
Yeah. It's interesting to me because as a statistician or as a as an applied mathematician, that's kind of my background a little bit. Um, I tell people in my mind, it's a very simplistic. It's not statistically the most sophisticated exercise that we're just about to do. So don't, if anybody else is a mathematician, do not hold this up to scrutiny. It's just an example and a way to think about it for a individual client who isn't a statistician. Okay. So every time you make a decision, there's two outcomes. You're right or you're wrong. Right. So there's a 50-50 probability that you're going to be right or you're going to be wrong in any decision. But in this case, the decision to sell. Okay. Well, if you're right, okay, great. If you're wrong, not great. All right. Well, when you sell, right, it's a 50% probability. It goes down. You now have another decision point that's 50-50. Okay. So 50-50 times 50-50, what is that? A half
Mm-hmm.
times a half is a quarter.
Is a quarter. Yeah.
Right. So you have a 1/4% probability of being correct twice. So in other words, 75% chance of being wrong on one of those two decision points. So if you were sitting there and you just did this very simple example and you have 75% of a probability of things going wrong and 25% probability of things going right, would you ever choose the 25%? Very rarely. Okay. And there's a lot of reasons why certain people would. And for those who are financial mathematicians, yes, I understand all of that behind it. This is just an thought exercise for an individual client. But generally speaking, most clients will go, no, I will stick with the 75% probability. Okay, well, that means you stay in. That means you don't make the first decision. That then implies the second decision, right? You just
Mm-hmm.
stick with it. All right. And so um, it's an interesting thought process because when you put it like that, clients are like, oh, you mean it's better for me to stay in now? Yes. Even if there's short-term discomfort and pain and worry, it's better for you to stay in. Now, I will say, I'm just about to contradict myself a little bit, so forgive me. The next category is 20% plus bear markets. Okay. Um, they happen once every 3.5 years. So not too often. They're pretty rare. Okay. But they still happen pretty regularly. Right.
Hmm. Yeah. In
And
our example of a 40-year time savings time frame, that's going to be 11 times. You're
yep.
going to experience that 11 times in your 40 years of accumulating.
Right. And what happens is this is 20% plus. And this is where I'm trying to make the distinction between this category and other categories. Okay. You should not sell out during a 20% bear market, but you should do some things to perhaps reduce the risk of it going to 40, right? Or 50% down, which a lot of bear markets have seen drawdowns of 40 to 50%. So those
Mhm.
those are not outside the range of possibility. So, and most people do get very worried when all of a sudden their money is cut in half. Okay.
Right.
That is, we understand the emotion behind that, that we understand. Um, lowering your probability. So for example, if you have 100% in stock and that outcome of having a bear market of 50% is too much for you, then reduce your equity exposure a little bit. Add some safety in there, right?
Hmm.
At Juncture, what we do is we have some hedging protocols that we use to hopefully our target is to blunt half of a 20% plus drawdown.
Yep.
Okay. That's our target. Now, do we do it every time? No. But that's our goal, and that's what we try to do. Um, because those can be pretty dramatic drawdowns and they can take a year or two to get out of. So that is where, you talk to your advisor, financial manager, what have you, about how to um, mitigate the damage from those really big occurrences. The smaller occurrences are pretty, like you said, they're pretty regular, they're pretty common. I wouldn't panic on those. I'd buy in on those for the most part. But the 20% bear markets are something that you probably need to have a strategy in place ahead of time so that you're not making emotional decisions during the time where the drawdown is pretty severe.
Yes. And I wanted to share from, an advisor perspective where you literally, manage my client's money, my own money, right? Like all of that. Um, this Looking at this chart right here, we've got the 3% dip, the 5% mild correction, the 10% correction. The hedging protocol that we use starts to take into account, right? After, well, kind of like between the 5 and 10, right? Is where we as a team start to be like, okay, what's the strategy going to be going forward? And so from, this whole conversation does and does not take that into account in some ways, right? So like overall, we're encouraging people to stay with their plan, whatever their plan is. Like don't don't panic at a 5% correction, or mild correction there, right? And at Juncture, we have tools and protocols that help us create that. Literally what it's doing is helping us create the cash to reinvest at the bottom, right? That's part of it without going into like the whole strategy. But just that's okay, we're going to take a little bit off the table and we're going to then have cash at the ready when we hit these lower points.
Correct. And that is the most important part of that whole strategy, is not necessarily mitigating the volatility's damage, although that is certainly part of it. The most important thing is to give us cash to invest when the markets are extraordinarily sold off.
Hmm.
That's our most important, because generally, if we're fully invested, you don't really have excess cash to invest in a meaningful way when the markets are selling off, right?
Right.
Unless you have some bonds in your portfolio or some cash on the sidelines, something. So that's generally what we do is we put together a cash reserve or some surplus funds that give us the opportunity to buy when that stock is very, very sold off.
Yeah.
Like I said, I buy things when they're on sale.
It's good. The Cheerios is a good example. And I'll leave it at I'll leave it at this example as well. Talking to a client this week, having that um, really, really feeling anxious about everything that's happening from the market movement to the news to all of it. Exactly what we're talking about here. There is that fear of what if it goes to zero? Like none of this matters if I don't have any money anymore. And so when we look at the dollars, we talked about this before, but I'm like going to open it up. When we talk about the dollars, that can feel scary. When we talk about the shares of company stock that you own, that's where we need to put a little bit more of our focus. So if you have companies that are solid, that are um, you know, not a recommendation by any stretch of the imagination, but just being in Cincinnati, right? Like Procter and Gamble is a huge company here. Tons of people in Cincinnati have Procter and Gamble stock from being employees, having options and whatnot, right? So, do you believe if your Procter and Gamble stock goes down by 50%, but you maintain your shares, let's say it's at $100 and it goes down to $50 per share, but you still have your 100,000 shares of P&G, do you think it's going to stay there at 50? Or do you trust that company to do what it needs to do to right the ship to come back up? For most people, the answer is, yeah, I do trust. I trust that they're going to right the ship, that if I don't sell my shares, that amount, like the dollar amount will go back up because I didn't sell my shares. That's the math that we're doing here is yes, I realize the dollars feel bad. It feels bad to see your money dollars go down 5%, 10%, 15%. But if you maintain your number of shares in companies that are have a proven track record of making it through crises, then you will ride the wave back up with them, is the point, right? As long as we don't get rid of the asset that you have, the stock shares that you have.
Exactly. That's exactly correct. And that's important for people to understand is stay invested. It's um it's critical. It's critical to your financial goals. Um, and there's some charts that I can show if people want us to show them in future episodes. There are some funny charts that mimic what an individual investor thinks during different market cycles, all the way from exuberance to complete depression and
Mm-hmm.
at the different times. Um, and then there's also a chart which tracks from basically the 1900s through 2024, all the different reasons why you should not have invested in equities each year. And there are some, reading through the reasons why you wouldn't have. It's the who's who, it's the greatest top 100 reasons why you would, and they're all really bad. Like
Yeah.
the things on that chart are like World War II, World War One, you know, dropping the nuclear bomb. Okay. Um, Pandemics, two pandemics actually. I mean, there's so many reasons, inflation at 15%. Well,
Dot
there's still
com. Dot com
the
burst.
dot com burst, right? NASDAQ down 75%. I mean, there's all of these different reasons why you wouldn't have. But at the end of the day, if you maintain a pretty diversified portfolio and you held on to it over that time frame, you're very wealthy.
Mm-hmm.
You're very wealthy and you've met your financial goals, okay, for the most part, unless they're just completely unreasonable. Um,
We don't know
and that's,
everybody's situation.
yeah, we don't know everybody, but generally speaking, if someone did that, they'd be very wealthy and probably well cared for. And so it's something that people need to understand, that volatility as an individual investor gives you an opportunity to buy assets cheaper than they otherwise were priced just prior to this. So I would encourage people to try to think opposite of what the stock market is doing. Okay. When the stock market is up very, very high, think about trimming out a little bit. Not a ton, but take some off the board if you think it's too high. All right. If it's really, really beaten up, think about buying some more. Buy more stock, right? It's on sale. And that will help you get to your financial goals and you'll be able to get through it.
All right. I think we're going to pause it there for this week. It's another, so far, a little bit volatile on the downside. Today, as we're talking, it's 11:13 at this point. So, Brad, I'm going to let you go and take care of some trades that
Will do. Thank you.
probably are needing to be done right now. But thank you for
Yes, they are.
listening. If you have questions, you know how to find us, and we will talk to you next week. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, @expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.